Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Webull. Right now, if you deposit $100 or more, you could earn up to 20 free fractional shares by using my link in the description below. Remember, each share is valued between $3,000 and $3,000. So go ahead and check out Webull. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. So I'll put a link to it in the description below as well. Now let's get right into today's video. So, are you bad at guessing the direction a stock will move? Maybe you buy calls and you wish you would have bought puts, or maybe you buy puts and you wish you would have bought calls. Every time you buy an option, the stock ends up moving in the opposite direction. Well, today I am going to show you an option strategy where it doesn't matter which direction the stock moves, as long as it makes a big enough move. So you no longer have to guess here. As long as you believe the stock will make a big enough move, does not matter if it's going to go up or down. Now, for today's video, I'm going to be using QQQ. The reason I am using QQQ is because if you don't know yet, QQQ actually has daily expirations here. So it has options expiring every single day, which means theoretically you could implement this strategy every single day if you wanted to. So I'm going to be using QQQ as an example here today. And again, everything I'm showing you here is just an example on how this specific option strategy works here. So the first thing we want to do is we want to go into the options for whatever security we're using. And you first want to select the appropriate expiration date. So, we want to make sure that this move happens prior to the expiration date. So let's say I think this move will happen before our expiration date on May 20. So I'm going to go ahead and select the May 20th expiration here. Now, the next thing that we want to do here is we want to go over to sell first here. So I'm going to switch over to sell. We want to sell some options here first. And now we want to first determine if the price goes up here for QQQ, what price do I believe it will go above? So let's say I think that if QQQ goes up, I think it's going to go over 530. So the first thing I would do here then is I would go and find the option with that strike price. So here's the 530 strike. And I would start by selling a call option there. So here's the option with the 530 strike. I'm going to go ahead and sell a call here first. So again, what we've done here is we determined what price do we believe QQQ will be above if it goes up. And I say, let's just pretend I believe it would be above 530, at 530 or higher. So I sold a call at the option that has a strike price of 530. Now, the next thing I want to do is I want to determine if the price of this security goes down, what price do I think it will be below? So let's say if I think QQQ instead goes down in price, let's say I think it'll be at 510 or lower. So what I'm going to do here next then is I'm also going to sell a call on that option with that strike price. So if I think if QQQ goes down, it's going to go under 510. I'm going to find the option with a strike price of 510, which is right here. And I would sell this call option here as well. So I'm going to go ahead and select it here. So we sold 2 calls here so far. Now, the next thing I want to do here is I'm going to switch back to buy here, because now we want to buy a few call options here. So now what I want to do is, this part is very important here. What I want to do here is I'm going to buy some call options. And the strike price we select here needs to be very specific. So what I'm going to do is I'm going to look at the calls that I'm selling. So I'm selling 2 calls here so far. So So I'm selling a call at 530 and I'm selling a call at 510. So I want to go ahead and subtract the strike price here. So if I subtract the strike prices here, if I take 530 and I subtract 510, I get 20. And then I want to divide that by 2. So that gives me 10. So what does that mean? That means I want to buy a call that's $10 away from each one of these strike prices. Basically right in between both of these strike prices, because the calls that we're buying here, we want to make sure they're equidistant from the calls that we're selling. And so that would be the one at the 520 strike, right? So we go to the call we're selling here at the 510 strike. If we add 10 to that, we get 520. Same thing with this one from the call we're selling at the 530 strike. If we take 10 away from that, we get 520. 520 is the one that's right in between both of these. So then we want to go ahead and buy a call at the 520 strike here. Now we don't want to buy just one call here. We want to buy actually 2 calls. So how can we buy multiple call options with the same strike and same expiration date? So here on Robinhood, we want to go to the top right here. Notice that there's this chevron icon. If you click on it, we want to click on custom here. And here we can set a unique ratio. So if you want more than one option here, this is where we can change it. So for the calls we're buying, we don't want to just buy one. We want to go ahead and buy 2 here. And so now we have our strategy set up here. So if we take a look, we're going to be entering for a credit here. And since we're entering for a credit, that means we're going to have to put up some collateral. And you can see that right here, collateral. Now, let's go back here. Now, so we're entering for a credit. We're putting up some collateral. We can see down here kind of what our profit or loss chart might look like here. But again, I prefer using OptionStrat. So let's head on over to OptionStrat. Let's visually take a look at what this trade might look like depending on the share price, the date, and a couple of other things. So let's head on over to OptionStrat, and I'll put a link to OptionStrat in the description below. Really great options visualization tool. So it helps you visualize an options trade. And so if we go here, we can go to build, and I'm just going to go to a regular call. I'm just going to start from there. So again, let's go to the ticker symbol we're using for today's example. So I'm using QQQ. So here's QQQ. And then I selected for this example an expiration date of May 20th. And so remember, the first thing we did was we sold a call at the price that we believed the stock will be above if the price of the stock goes up. So I said, let's just pretend we believe it would be above 530 if it goes up. So we started by selling a call at the 530 strike. Let's switch this to sell call here. So here's the call we're selling at the 530 strike. Then we said, okay, now we want to also sell a call at the strike price we believe the stock will be below if the stock price goes down. So we said, well, if QQQ goes down in price, let's just pretend we believe it would be under 510. It would go under 510. So now we also need to sell a call with a strike price of 510. And then finally, we said we needed to buy a couple of calls here. Both those calls need to be equidistant from the strike of the calls we're selling, right in the middle of them. Again, very simple way to do that is you subtract the strikes here, which gives us 20. And then we divide that by 2, that gives us 10. So it's going to be the one that's 10 away from both of these. So we take 10 away from this, we get 520, or we add 10 to this, we get 520. So we want to buy some calls at the 520 strike. We want to buy 2 of them here. So I'm going to switch, and under quantity here, let's switch to 2. So as you can see, this is called the short call butterfly. OptionStrat recognizes that as the short call butterfly. Let's zoom out a little bit here. And so let's start going through this here. So our net credit is $451 for this example. Notice our max profit is going to be limited to the credit or premium we receive. We also see our max loss here. And remember, we're entering for we have to put up collateral when we enter this strategy. So for this particular example, as you guys saw, we would have to put up $1,000 in collateral. If we take $1,000 in collateral and we subtract our net credit, that's what gives us our max loss here. Now, if you have the premium version of OptionStrat, it'll give you this chance of profit section here. According to OptionStrat, our chance of profit for this, 50 or almost 50%, 49% here. And then we get our break evens here, because again, we can make money both ways with this strategy. So this is telling me if QQQ at expiration is above 520.549 or below 514.51, we're going to make money here. Now let me go and be a little bit more specific with a couple of things here. So first of all, where are we going to make our max profit of 451? So you're going to make your max profit if at expiration the price of the stock is at the strike of the calls that we sold or higher or lower, right? So if QQQ at expiration is at 530 or higher, or at 510 or lower, we're going to make our max profit. And you can see that through the chart here. If it's at 530 at expiration or higher, notice you're going to make 451. If it's at 510 at expiration or lower, notice you're going to make $451. That's how you're going to make your max profit. Now, where are you going to make your max loss of 549? So you're going to get that max loss if at expiration the price of the security is exactly at the strike of the calls that you bought. So if at expiration QQQ is exactly at 520, that's where we would make that max loss of 549. That's where we would lose $549, as you can see here. So just to be a little bit more specific with this here. But again, the biggest thing here is, if you're bad at choosing which direction the price of the stock is going to go, this allows you to make money both ways as long as there is a big enough move here. You can make money up, you can make money down here. Now remember, you can close out of this strategy at any point in time as well, and I'll put a link in the description below where I show you how to close out of any options trade, including this one on Robinhood. So I'll link that in the description below as well. So again, this is the short call butterfly. You can make money both ways here as long as there's a large enough move. You will be entering for a credit or a premium, which means you'll be closing for a debit. So if you have any questions, feel free to leave them in the comments section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.